Okay, the chapter 70 for the cash flow statement. What we covered last time was the basic about the concept about the cash flow statement, which is the cash is the one that's technically the cash you can say is the blood of the company. If there's no cash, the company cannot operate. Cash flow statement as income statement as and a statement of the retained earnings is prepared for the period of time, not at the point of time, for the period of time, and shows you what's happened with the cash from this point to that point, to that period, what's happened with the cash. Um, on the cash flow statement, we literally looking what's happened in the cash account and cash equivalent account. Starting with the beginning balance, and we have to reconcile everything all the way to the ending balance by finding from where the what gives the increase in cash and what gives the decrease in cash. The purpose of the cash flow statement obviously is to predict the future of the company. A company without a good operating uh, cash from the operating activity, obviously it's not going to be successful in the business. The cash flow statement is going to help you to evaluate the management decision that determine company ability to pay dividend and debts. Now, what I want you to understand is that net income is not equal to cash. The purpose of the cash flow statement is the other thing is when you see a negative operating cash from the from operating activities means that the company it's going most likely it's going to go to the end. If that negative operating activity cash continue for 2 years in a row to be negative, that's definitely for the business. For the business means the business going to go to bankruptcy. That's not the same when you're doing the cash flow statement, the cash flow prediction for the non-for-profit institution and government. Government, as we said, they are okay to work on the negative cash flow for unlimited number of years. Cash and cash equivalent. What we doing is the cash flow statement, including the cash, the changes in cash and cash equivalents. And cash equivalents are very fast liquid cash, something that can be converted into cash very fast, usually within 3 months. How are we going to set up this cash flow statement? We have two approaches. One is direct method, the other one is the indirect method. The indirect method, as we said last time, starts directly with the net income rather than chasing the sales and the expenses. That will be the main differences. There are three sections of the cash flow statement. One is the section of the operating activity, the other one is the investing activity, and the third one is the financing activity. Operating activities is anything related to the working capital of company or current assets and current liability. Where investing activity shows how much cash the company spent on the capital assets and how much cash the company get from those investments that they made. The investment can be in other companies in forms of debt or investments or equity. Depends on what the company decide to invest in. And the last one is the financing activity. Financing activity, including the last two parts of the balance sheet that we haven't covered yet. That will be the long-term debt and investing activity or equity section of the balance sheet. So that will include the shares, dividends, from where the company get the long-term debt and how much the company owns in the long period of time and how much cash is involved in those operations. So simply, if we have to visualize this, operating cash flow again is current assets and current liability only, which is our working capital. Investing activity including only the long-term assets financing activity, including the long-term liabilities and owner's equity only. Uh, discontinued operations are shown separately on the income statement and the cash flow statement altogether. For the investing activities, now once we start seeing the transactions that happen in the cash, in which involves cash, we may see some investing and financing activity, which are treated as a operating activity, which is totally normal. What I want you to remember is the interest received and paid from the company with cash is treated as part of the operating activity, and dividend received, only the dividend received, are treated parts of the operating activities of the company, usually, unless it's otherwise specified in the question. The last thing left is the payment of the dividend. The payment of dividend is clearly financing activity. So what you have to remember, interest, payments, and receive operating activity, dividend. The dividend that you're getting is operating activity, the dividend that you pay, financing activity. Non-cash is not part of the cash flow. Why? Any non-cash transactions, exchange of goods, exchange of services, anything like that, not part of the cash flow statement. So the company can pay for the assets with issuing the long-term debt, like a bonds or equity, like in form of shares. That's not part of the cash flow statement since it doesn't involve cash. So what you have to do, go back to the journal entry or try to recreate the journal entry, see if the cash is involved, where is the involvement, is it on the debit side, on the credit side, and do the adjustments to the cash flow statement based on how the cash is involved. Free cash of the company. Free cash of the company or free cash flow is the net cash provided from the operating activity. So any positive cash that you may get from the operating activity minus the payments of the investment in property, plant, and equipment or long-term assets. That will be the free cash of the company. Now we start preparation of the cash flow statement. We saw that last time, and today we're going to continue with this. First one is the indirect method, and indirect method is the only taught by the academic side in Canada, mostly. I would say mostly because I know some teachers teaching the direct method as well. Anyway, as I believe I showed you last time, what's the difference between direct and indirect method. But indirect method itself starts with the net income. Now, the indirect method is applied only and only to the operating activities. The other two activities, investing and financing, they're prepared only one way. There's no direct and indirect there. Direct and indirect is affecting only and only operating activities. So what will be the difference then? In the direct method, we seeing all the elements from the income statement in terms of sales expenses, where in the indirect method, we working directly from the net income, which already including the sales and expenses. Operating on the indirect method, we have to make adjustments though for the non-cash items which are included or accrued into the net income, since we're not dealing directly with the sales and expenses. So for that reason, the first thing that we have to do is when we're preparing the indirect method operating activity cash flow, is start with the net income. Second part is to adjust for the non-cash items, which are already included in the net income in forms of the revenue and expenses, or gain and losses. What that means is first we have to, anything which is already deducted as expense or loss, affecting the negative income in the negative way, so we have to add it back. And anything that involves revenue, which is not a cash that have a cash item like a gain or any accrued income has to be subtracted since affect the revenue in the positive or negative net income in the positive way. We saw in order to prepare the cash flow statement, we need the balance sheet and we need the income statement. From the income statement for the indirect method, we're going to start with directly for the net income. And after that, we're going to start adjusting for the non-cash items. Last time we saw this month, we started with the net income, $100, and then we're going element by element and trying to find out, is there any non-cash item and how those affect the net income and what kind of adjustments we have to make. So if we take a look closely, sales revenue seems like a normal, interest revenue is a normal, dividend revenue is a normal, gain on sale of the property, plant, and equipment, that gain, in fact, it has no cash equivalent. So since the gain, as you can see, is part of the revenue, that means increasing the net income, we have to deduct those $19 from the net income in order to adjust for this non-cash item. The next non-cash item is amortization expense, which has no equivalent, no cash equivalent. So basically what we have to do, since the amortization expense reducing is part of the expenses and reducing the net income, we have to add it back in order to eliminate the effect of reduction of the amortization expense. So we're going to add back $43 and we're going to deduct $19 in order to come up with the adjusted net income before the adjustments that we have to make for the working capital. Once we go to the balance sheet, once we finish with the income statement for adjusting the net income to bring it to the cash net income, then we start working with the balance sheet and start tracing the changes in the working capital through the year. How are we going to do that? We're going to compare the beginning balance with the ending balance. And I already told you beginning balance minus the ending balance is going to give you a number. And that number, if it's a negative, beginning minus ending balance, if it's negative, it's going to reduce your cash. If it's positive, it's going to increase your cash. And keep going with this, all the current assets. Then we're going to apply to the current liability. On the current liability, again, we're still going to start beginning balance minus the ending balance. But since it's a liability and affect the cash flow on the in terms of the outflow or negative way, we have to put negative sign in front of the equation. So it's going to be minus bracket beginning balance minus the ending balance. Close the bracket. And that's going to give us a number, which number, if it's positive, is going to increase our cash. If it's negative, it's going to decrease our cash. So if we have to prepare again, we're going to start with the net income. Then we're going to do adjustments for the non-cash items. We're going to add back the amortization expense. We're going to deduct the gain. And at this point, we're bringing the net income into the cash net income, which will be equal to the cash income that we're going to get under direct method. And after that, we start chasing the changes in the working capital. First, with accounts receivables, interest receivables, inventory, prepaid expenses, all the assets, current assets. And after that, moving to the current liability, which is accounts payable, salaries payable, and accrued liability. Once we're done, we're going to see how much is our net cash from operating activity. That's under indirect method. Now, what will be the cash that we're going to get if we have to use direct method? It's going to be exactly the same. But it's not going to start with the net income. We're going to see later how that's going to happen. Again, we're starting with the net income, then we adjusting for the non-cash items by adding back the losses, subtracting gains, adding back the expenses, subtracting any accrued revenue. Then we're chasing the changes in the working capital, starting first with the current assets and then moving to the current liabilities. Once we cover all those items, we're done with the cash flow from operating activities. So what we have to understand is, again, first we're normalizing the net income to bring the net income into the cash net income by adding back amortization, depletion, and depreciation expense, deducting gain on disposal of the long-term assets, adding back the losses if we have loss, we're adding back that losses, and after that we're chasing the increases in the current assets and changes in the current liabilities. That's our operating activities cash flow. Next one is the investing activities. For the investing activities, we have to chase from the balance sheet any changes in the current assets account. Once we found these changes, we have to see what's the effect on the cash. So the general rule here for the investing activities, we're gonna begin with the income statement amount, see is there any gain and losses. After that, we're gonna chase through the balance sheet account and try to find out what's the amount of the cash involved in the transaction. For example, last time that we covered was the beginning balance of net amortized asset was 525, ending balance was 1,087,000. There's new acquisition of 735. Now the net income statement shows amortization expense of $43 and $19,000 gain. Now the question is how much cash was was received on the sale of the asset. And we're starting. Now the beginning balance was 525. We purchased new items 735 and then in balance 1,087,000. When we combine those two, obviously we're not going to get the number that shows here. We're going to get higher number than that. So that means something happened on the credit side. First, what happened is the accumulated amortization reduced the value of the net assets. And after that, we have to chase what was the book value of the assets sold, since we know that the assets that was sold, on the assets sold, we have $19,000 gain. So the net book value of that asset is going to be the sales proceeds, or how much we get from the sale. It's going to be equal to the net book value of the asset minus the gain. Minus the losses plus the gain. Once we add the gain, we're going to see how much cash we actually received. That's with that. We're going to practice more. I'm just mentioning this so we can cover the investing and financing activity before we move directly to the questions and practice how exactly this is going to work. Now, on the last part of the cash flow statement is the financing activity. And the financing activity affects the long-term liability in shareholders' equity. That includes note payable, bond payable, long-term debt, common shares, retained earnings. Now, if we issue a long-term debt, obviously we're going to get cash. How much cash we're going to get depends on how the long-term debt is. If the long-term debt exponentially increase, that means more cash for us. We're borrowing, we're creating more debt. So in this case, as you can see, beginning balance is 185, ending balance is 384. In the meantime, we issued new debt of 226. 185 plus 226, it doesn't give us 384. That means there's something on the debit side. And we start working on the amount on the debit side. How much is it? and until we find out that the payment that we use to reduce our debt is $27,000. For the shares, same idea. We're gonna check from the balance sheet beginning balance. We're gonna check the ending balance. We're gonna check the additional information. Is there any information about the common shares? If we see increase in the ending balance, that means we issue new shares. Well, if your company issued the new shares, that means the company receive cash. And that's gonna directly go to the cash flow statement under financing activities. It's gonna show that increase of the cash. On the dividend payment, now the dividend payment is a little bit, we have to work a little bit more by knowing from where the dividend comes from. And dividend comes from the retained earnings account. Yeah, but the retained earnings accounts have items which coming in. So you have to understand that the retained earnings consist beginning balance, ending balance, retained earnings increase with the income from the current year, and retained earnings decrease with the dividend declared. If we declare the dividend, retained earnings goes down. Now the next question will be, is the declared dividend has been paid? If we don't have a balance on the dividend payable account, that means whatever was declared as a dividend has been paid as a cash, which we're gonna reduce our cash. If we have a balance, that means beginning balance plus the dividend declared minus the ending balance gonna give you the cash paid. Again, we're gonna practice on this dividend and the retained earnings specifically. How the international financial reporting standard are different from the accounting standard for the private enterprises. Different treatment for some items which are very specific. Again, next course that when you're gonna start 331 intermediate financial reporting, you're gonna start with the international financial reporting standards, and then you're gonna have chapter 1 and 2 are basic chapters. Then we go in chapter 3 is the balance sheet. Chapter 4 is the income statement. No, it's opposite. Income statement first, balance sheet, and then is the cash flow statement. So in chapter 5, you're gonna discuss with the whoever your teacher is, the cash flow statement and how the cash flow is prepared under the International Financial Reporting Standards. So that's why I prefer to spend 2 chapters here, 2 lectures here on the cash flow statement, so you can have a jump start on the next course. That will be pretty much before your midterm. So pay attention again here. It's going to save you time in the next course. At least you understand you don't have a problem with the cash flow. So that's with the cash flow under preparation, under preparing the cash flow from operating activity under the indirect method. Let's quickly see what's the difference between, again, direct method and indirect method. Now, on the direct method, again, we're going to chase the revenue expenses. In the indirect method, we're starting with the net income, which direct net income already have the revenue expenses. That's why when we're starting with the net income, we have to make adjustments for the non-cash items, which involve revenue and expenses, to move the cash to get this cash from the operating activities. Direct method, again, is going to include sales and then changes in the accounts receivable account. Interest revenue plus changes in interest receivable account. Cash that we receive from the dividend, cost of goods sold. Now on the outflow, it's going to include cost of goods sold, purchase of the inventory on credit, salary expenses plus payroll payable account, payments to the suppliers for inventory and operating expenses. Amortization expenses will be excluded. Other operating expenses, we have to see is there any cash item there, and we're going to include it. And the last one left is the interest expense and payments and income tax expense and payments. So for direct method, first we have to identify which activity increase the cash and which activity decrease the cash. And we're starting with the first with the activity that increase the cash. Usually the revenue is the one that increasing the sales revenue is the one that increasing the cash. Plus, we're going to see what's the change in accounts receivable. Again, we're going to have exactly the same information. And after that, we're going to start with first, how much cash we get. Collection from the customer will be our revenue, 682. And then we're going to see how much of this revenue we actually received. As you remember from last time when we spoke, if the beginning balance of accounts receivables is equal to the ending balance of accounts receivables, that whatever we have as a sales, we have collected. But since the accounts receivable account increasing with $32, that means whatever sales we have here, we haven't collected $32. So 682 minus 32 is going to give us 650, which is our cash from customers. Next thing that we have to do is the next item, which is the interest revenue. Okay, we generating interest revenue $29. The question is, did we receive it as a cash? Again, if the accounts interest receivable account balance, beginning balance is equal to the ending balance, that means we received the entire 29. But since we have increase in the ending balance with 5, that means whatever we sold, whatever we receive as a revenue, $5 of those we haven't received. So 29 minus 5 is going to give you 24, which is the interest that we receive from the interest. Next thing is the dividend revenue. We have $22 interest dividend revenue. Now we have to say the dividend account is, do we have a dividend receivable account? Since we don't have the dividend receivable account, means whatever dividend revenue is here, we receive cash, all of it. So $22 is our dividend revenue that we receive, cash that we receive from the dividend revenue. And that's going to give us the cash inflow in this case. Now we have to see the cash outflow. Now they wrongly start with the employees. They should have started with the inventory, which now what we're going to see, cost of goods sold is 360 outflow. Now the cost of goods sold involves two accounts. First involve inventory account, and second involve accounts payable. Since inventory account is the asset account, and we're talking about now we're looking at the outflow for the company, we have to be careful here. Why is that? Because the cost of goods sold are expense, 360. Then we're changing the inventory. Inventory reducing. That means we're getting more cash. But that getting more cash, that's going to reduce the outflow with $7. The next thing that we're going to see is that we have increased the accounts payable with $83. That means we haven't paid. So for those expenses that he incurred for the cost of goods sold, we haven't paid $83. Plus the $7 in decrease in the inventory, which it have the positive effect. That means reducing the outflow. We have reduction of $90. So if we get from 360 minus $90, we're gonna get 270 that we paid for the cost of goods sold relation with the suppliers and inventories. Then we're gonna chase the employee. We're gonna see how much is the salary expense on the income statement. Salary expense is 134. Then we're gonna see, is there any salary payable? Again, if the beginning balance is equal to the ending balance, that means whatever expense we have here has been paid. But our salary is payable going down with 6. So that means whatever the expense is, we pay for it, plus we pay additional $6 to reduce our beginning balance. That means we have to add to the salary expenses to 134, we have to add additional $6, which we adding, and that's how we getting the payment to the employee, $140. Then we're chasing the supplies from operating expenses, and we see the operating expenses at 41. Then we're checking the balance sheet and says we have accrual liability here with $2. And then we have to make a adjustment here on the operating expenses, 41 plus those two that's increasing, we're gonna have actually the $2 is gonna decrease that one. It actually no, it's increasing the 40, and that's how we're getting this $44. Let's see again if that's calculation is correct. 41 operating plus 2 is 43. So that's not 44. I have to see how exactly they get this one. Let me see what they say here. On number 10, supplies for operating expenses, $44. Oh, yes. Okay, watch this. I see from where the one coming. Supplies for operating expenses. Again, we have the expense here of $41. Then we paid $2 more for the accrual liability, which adding $2 more to 41, but now become 43. And the last dollar increase comes from the prepaid expenses, which we use more cash here. Our balance going up. That means we're not receiving it. We spend less cash. So that $1 additional increasing that 43 and bring it to 44. And that's how we get from the supplies for operating expenses, $44 increase in the cash outflow. The next one is the interest. Interest, we have interest expense of $38. And then we're chasing do we have interest payable account? We don't have, so that means whatever the interest expense is, we pay that cash. So that's what your $38. The last one is the income taxes. Don't forget the income taxes because that's outflow for the company. Once you see the income tax expense 36, you're chasing, is there any income tax payable sitting on the balance sheet under the current liability? There's nothing there. So that means whatever the expense is for the income tax, we pay it cash, 36. And that brings our cash flow from operating activity of 168, which is exactly the same that was under the indirect method, which is, where was that indirect method? Just to see the calculation, 168 under the indirect method. So that's how we're getting the same amount from the direct and indirect method. So the thing that you may have problem here is again the supplies from operating expenses. In terms of in this case, you have to realize that this operating expenses 41 are not related only to current liabilities, but there's also current assets that affects it, which is prepaid expense. Increase in the prepaid expense, that means we pay more cash, which is reducing, it's increasing the cash outflow. Clearing the accrual liability, it's also increase in the cash outflow. That's $3 increase in the cash outflow, plus the 41 give you the 44 change, and shows you the amount that we use as a cash for the operating expenses. And that's how we're doing all the calculations here for the collection from the customers to get the other cash received, cash payment for the employees, again, beginning balance, the payment that we made, plus the beginning balance minus the ending expenses. So basically we see the expenses, beginning balance minus the ending balance, it's gonna give you payment cash used for the employees. For the suppliers, again, we have to work with the cost of goods sold. We have to find the changes in the inventory account and the accounts payable. For the operating expenses, again, we have to consider the cash payment made plus changes in the prepaid expenses and changes in the accrued liabilities. And that concludes the whole calculation. Now for the investing and financing activity, there will be no differences between direct and indirect method. Simple chart here, as you can see, is for the operating activity. We're going to have collection from the customers, receipt from the interest and dividend, and operating receipts. That's from the inflow that we may get from the operating activity. Outflow are related to the current liabilities, which is payment to suppliers, payment to employees, payment of interest, paid operating payments. On the investing activity, inflow is come from sales. Outflow is related to the investments. On the financing activity, inflow is related to issuing shares or issuing new debt. Outflow is related to payment of dividend, getting back the shares that we issue, or payment on the principals here on the long-term debt, not the interest, the principals. Interest payments go directly to the operating activities. That's how we should make a distinction between if I have a long-term debt, which pay interest, only the reduction of the principal is involved with the financing activity. The payment of the interest go directly to operating activities. And now you can see the direct method cash flow. And this is the first we're chasing cash receipts. Is not like that. I would change this one to, if I have a ability, I'm gonna change it to cash inflow and cash outflow. Cash inflow comes from customers, interest, dividend. So what we have to chase, revenue, sales revenue, interest revenue, dividend revenue. Cash outflow is related to payment to suppliers for the inventory, which is involve cost of goods sold, indirectly involve inventory account and accounts payable. Suppliers on the other items, operating expenses, which gives the rights on the accrual liability and prepaid expenses. Employees, salary, the accounts with salary payables, interest expense with the changes in the interest payable account, and the income taxes with changes in the income tax payable account. Now, as you can see here, if let me see if this is gonna work. If I get this shape, which is look like this one, and if I shape those items, only those items now in and this new color, I'm not going to change the color, but let me see if I can get another shape without filling inside. I guess I have to stick with this. Let's stick with this one again. But I'm not gonna change anything here. So okay, this one, the highlighted one, which are in the box. If you look at closely at this, if you get the revenue minus expenses, at the bottom you're gonna get net income. And after that, you have changes in the working capital. On this side is the changes in the working capital. So you have the net income here, which doesn't include the non-cash items. And after that, changes in the working capital. So that's why when we're doing the indirect method starts with the net income. Then we're normalizing for the non-cash items by adding back the depreciation expenses, losses, and deducting the gain. Once we do that, then this chart that I'm showing here, the highlighted items, and the normalize, if we calculate all of those and come up with the income, and the indirect method, net income, after adjustment for the non-cash item, those will be exactly the same. And the next thing that left for both indirect and indirect method is to adjust for the changes in the working capital in terms of current assets and current liability. And that's how you're getting exactly the same number. There's no magic here. There's nothing like something extraordinary. It's just simple logic. I hope you understand it. So now let's go and do some practice because that was the last slide for this chapter. I'm going to stop sharing here. I'm going to pause for a second and we can start. So this question, very simple question. Again, we're focusing only on the operating activity, cash flow from operating activities. That's all we're going to do. This company has prepared this information for us. They have, as you can see, balance sheet statement, financial position, which is the balance sheet. That's how the balance sheet is called in the International Financial Reporting Standards, statement of financial position, and statement of profit and losses. We're observing quickly both statements. Nothing scary, everything looks fine. We have sales, we have everything, we have expenses, net income. And then we have here assets, liability, equity. Those are in balance. Everything looks normal. Nothing scary so far. Okay, so the first point is of the starting of the cash flow statement. First, we start with the name of the company. Second, we start with the name of the statement. Third, we say for what period of time this statement is prepared for. So cash flow statement is prepared for the period of time. So that's one reason we're saying for the year ending December 31st, such a year. Then we putting the name of this first section of the cash flow statement, which is cash flow from operating activities. And the next thing is starting with the net income. Do we have our net income? Yes, we do have it. Our net income in fact is $29, and that become our starting point, and that's how we start the statement of the cash flow. We have the first, which is the net income, 29,123. Now, once we have the net income, we have to identify from the income statement, is there any items which are non-cash items? In order we to make adjustments for non-cash items. That's our first job. Not cash, that should be cash. That's the first thing that we have to do. We have to make adjustments for the non-cash items. First thing that we have to do is so we start with the net income. 29, that's our starting point. Then we have to make adjustment for the non-cash items. We see sales, normally those are sales, no problem with that. So this one is okay. Cost of goods sold, that's outflow, no problem. Then we have gross profit, which is purely calculation. That's not even item on the related to expense on it. It's just calculation. Next one we have depreciation expense, which depreciation expense is part of the expenses. That means reduce the net income. The question is, do we have to pay for the depreciation expense in cash? What do you say? Yes or no? In other words, is depreciation expense cash item? Can I go to the store and buy depreciation?
Oh,
No. So that's a not cash item. So we have to make adjustment. Now, what kind of adjustment I have to make is, let's think about it. This is the expense. If it's expense reducing my income, in order to eliminate it, I have to add it back. So I have to add back those $17,000. Okay, interest expense seems like a okay expense. Then we have loss on sale of capital assets, $6,000. The question is there cash involved in the loss? Can I buy loss with cash? What do you
no.
think? No, obviously. So that's a non-cash item. Which non-cash item reducing my income? So in order to eliminate it, I have to add it back. So let's add it back and let's see what's going to happen. Loss on sale, and we're going to add back $6,000. So we adding back $23,000. If we add those two items, now where is my income? Sorry, where's my cash? Uh, yes, my cash net income, $52. Can you see it? My income start with 29. I adjusted for the non-cash items, and now my cash income is $52. Now let's do the direct method here. I never done this before, but let's do it with you. Direct method. In direct method, we're taking the sales. Our sales are 250. That's our inflow. Then we start doing with the outflow. First, we have cost of goods sold negative. That will be negative of this amount. Oh, okay, 160. Next one will be depreciation expense, but that's not cash item, so that will be 0. Interest expense, let's pretend that everything is okay here, minus 7,000. Loss on sales, there's no cash equivalent, we don't have to include it. And the last one is the other expenses. Let's pretend everything is fine with those 31,000, so they're cash involved. If we run this calculation, what's the amount I'm gonna get? $52,000, which is exactly the same amount I'm getting when I start with the net income and adjust for the non-cash items. Make sense? Now I'm on the line of the direct method. I brought the indirect method, starting with the net income, into the income, which I'm going to get under the direct method. The last thing that left is to see what are the changes in my working capital. For the working capital, what I'm going to do, I'm going to take the accounts receivables. Cash is a current asset, but that's why I'm doing the cash flow to see from where this increase of $30,000 came from. So let's leave it for now. Let's go with the accounts receivables. It's my first current asset. Let's highlight it with blue. Then I have inventory. I have to see what's happened with the inventory, number 2. Then I have to see accounts payable. Accounts payable is current liability. And then I have interest payable. I have to see what's happened with this interest payable as well in order to identify all my current liabilities. So I have 1, 2 current assets and 1, 2 current liabilities. Capital asset, long-term asset, accumulated depreciation, that's another contra account to the capital asset, so we're not worried about this. Long-term note payable, that's a long-term debt. Ordinary shares, nothing wrong with that. Those are related only and only to the common shares. And the last one is the retained earnings. So let's start with the first one. First change, we're going to see what's happened with accounts receivables. Now, once we have the accounts receivables, what I'm going to do some adjustments here. Get this one alignment. Let's put it a little bit inside like this. Now I have my accounts receivables. What was the rule? We're going to do inside beginning balance of the accounts receivables minus the ending balance of accounts receivables, which in our case is, let's make it a little bit bigger. In our case will be bracket $57,000 minus $53,000. Close the bracket. So what's going to happen if we have 57 minus 53? $4,000 increase in our cash. Let's think about it and see if this makes sense. Again, if my beginning balance is equal to my ending balance, that means all the sales that I'm generating during the period, I receive it as a cash. Now, my beginning balance is higher my ending balance. What that means? That means I not only collect the sales, but I already collect some of my beginning balance, which was outstanding at the beginning of the year. How much I collect more? $4,000. I collect my sales, plus I collected $4,000 more. So that's why we have, from the changes in the accounts receivables, we have increase in our cash with $4,000. Next item, inventory. On the inventory, we're going to do exactly the same. Beginning balance of the inventory minus the ending balance of the inventory, which is beginning balance of 65 minus 70,000. So let's see now what's happened here. 65 minus 70, it's giving you decrease in cash with $5,000. Let's think about and see, is this make any sense? It should. So the first thing first, beginning balance was 65. Our inventory increased with 5,000. Did we purchase that inventory? Most likely. Did we use cash? Most likely. So that's your decrease in cash with $5,000. Why? Because we use the cash to pay for the inventory. And we're done with the current assets. We cover both. That's was current. That was accounts receivables here. And this is our inventory. We're done with the current assets. Now let's go with the current liability. First, we have accounts payable. For the accounts payable, what we have to understand now, since here we're looking the cash only from one perspective, not like a direct method in the inflow and outflow, we're chasing only on one perspective. We have to understand that changes in assets always going to be beginning minus ending, but the changes in liabilities, we have to make some adjustment, slight adjustment to make it as an outflow negative. And then we have accounts payable beginning balance minus accounts payable ending balance. So what I'm going to have in negative inside the bracket, I'm going to have 56,000 minus 60,000. And let's do it. That will be equal negative 56 minus 60 inside the brackets. And that's going to give me, I have to put equal sign here. Oh no, I know why is this. This is because, this simply because of this should be 56, 1, 2, 3, and this should be 60, 1, 2, 3. If I change it this way, then the numbers will be fine. So now, it shows my cash increase with $4,000. Let's think, is that make any sense? So, from the cost of goods sold that I purchase, if my beginning balance of the accounts payable is equal to the ending balance, that means I pay for all the cost of goods sold. But my accounts payable was 56 and now increased to 60. So that means from the cost of goods sold, which is 160, I haven't paid $4,000. I have them, but I haven't paid. They're sitting in my accounts payable. I have to pay in the future. So that means in the current period, I didn't pay $4,000, which is positive for my cash, which makes sense. That's our increase, how we adjusting for the increase in accounts payable. Now let's see the other one, interest payable. What we're going to have, again, since it's current liability, we're going to have negative in front of the bracket. Okay, I'm changing here a little bit. Let's make it beginning balance of accounts payable and ending balance. Let's stay in the same in accounts payable. So here we're going to have beginning balance of the interest payable minus the ending balance of the interest payable, or negative bracket 5,000 minus 1,000. Let's see where we are. Negative bracket 5,000 minus 1,000 inside the bracket, close the bracket, and we have reduction of our cash with $4,000. Let's see what if this makes sense. Now, we have thus our interest expense, which is $7,000. Again, if 5,000 beginning balance was equal to the 5,000 ending balance, that means we pay the entire interest expense. 7,000 is paid, and nothing more, nothing less. Now, we pay the $7,000, but also we decrease the interest payable account balance by $4,000. That means we not only pay for the $7,000, we also pay additional $4,000 from the interest payables, which reducing our cash with $4,000, which makes sense. So now, our cash net income, which confirmed by direct method calculation, is 52. From the changes in the working capital, we have to make adjustment for negative 1,000. So our cash from the operating activity, net cash flow from operating activity, is $51,000. So since we have this question, again, we have the extract from the balance sheet. Let's prepare the operating activities. Starting point, name of the company. Second, name of the statement that you're preparing. Third one, period of time for which this statement is prepared for. And then we can start with the cash flows from operating activities. Ink form on the operating activities is used because that will be continued operation. It's not going to be discontinued operation, something that's going to go in the future. And flows because its cash flows is part of the other flows, which are part of the statement of the cash flows. So let's start. First, we have to start with something. And since we're doing the indirect method, question asked, prepare the operating activity section of the statement of the cash flows using the indirect method. That means we have to start with net income. So let's go. Net income. In our case, the net income is 252,123. We have our net income. Next thing that we have to do is we have to adjust for the non-cash items. The question is, in this net income, which is 252, do we have information about the non-cash item that might be into this amount? Do we have any information about expenses? As we can see the question, yes, we do. What says? It says that the depreciation expense for the year is $56,000. So in that income here, 252, we have $56,000 expense, which reducing the originally the income, with $56,000. Is there cash involved in the depreciation expense? We already established there's no cash item. That's not cash item. So what we have to do? We have to add it back. What we have to add? Depreciation expense. And we're gonna add it back. Let's do this formatting very quick. And we're gonna add it back, and we're gonna add back $56,000. And once we add back this $56,000, our normalized cash net income become $308,000. Now we have to start chasing changes in the working capital. For the changes of the working capital, what we're gonna do? We're gonna start chasing first current assets. We have 1, 2, 3 current assets, and then current liability, 1, 2, 3 current liability. So first one, what we have? We have accounts receivables. What we have in the brackets? Beginning balance accounts receivables minus ending balance of accounts receivables. That should be capital here. And then we start doing bracket. 103, 600 minus 126, 123. I can easily copy this bracket, move it here, put a equal sign, paste it, and boom, should give me the calculation. Doesn't give me because I have this commas, otherwise it's gonna should be able to give me. So I have decrease in my cash with $22,400. Let's think about is that makes sense. What's happened with accounts receivables? It's going up. Accounts receivables increasing. What that means to us? We're selling, but we're not collecting our cash. How that affect our cash? Negative way. Increase in accounts receivable shows that we haven't received the sales. But again, the sales, interesting thing is already in our net income. We're working with the number that is already included in the net income. That means from that number which is included here, we haven't collect 22,400. So we have to reduce the cash with the 22,400 since we haven't collect ourselves. Next item, inventory. What we're going to have? Beginning balance of the inventory minus the ending balance of the inventory. And we're going to have in the brackets, open 117, 600 minus 89, 600. Close the bracket. So we're going to have 117, 600 minus 89, 600. So that means increase in our cash with $28,000. Is that make sense? Well, our inventory going down. So that means we're selling the inventory. But we sold more inventory. We released more inventory in our sales. So that means that gives increase in the cash with $28,000. Which makes sense. Since the inventory balance going down, that means positive for the cash. Inventory flows to the cash. We're getting $28,000 extra. Good. Next one, prepaid expenses. What we're going to have? Beginning balance of the prepaid expenses minus the ending balance of the prepaid expenses. And in the brackets, we're going to have 47,600 minus 53,200. Close the bracket. And how that's going to be? 47,600 minus 53,200. Negative $5,600. What that means to us? Means that we're using more cash. We use during the period, we paid the expenses, but we prepaid for more expenses. We use $5,600 more. Since we have increase in our prepaid expense, we're using extra cash of $5,600, which give reduction in cash with the same amount. And we're done with the assets. Our assets are done. Now let's go to the next one and let's check the liabilities. First liability is accounts payable. Now, since we're moving to the liability now, liability means outflow. We have to start in the formula beginning minus ending. We have to start plugging minus in front of the bracket. And we're going to have beginning balance accounts payable minus the ending balance of accounts payable. Close the bracket. So we're going to have minus bracket 64,400 minus 84,123. And here we're going to have minus bracket 64,400 minus 84,123. Close the bracket. I have increased from accounts payable, I have increased in cash with $19,600. Let's think about it. Our accounts payable balance going up. That means we don't pay. We purchase what we purchase. We have it as expense, but we haven't paid for it. Which means we're saving cash right now, this period, with $90,600. So that have a positive effect on our cash flow with 19,600. Let's see the next one. Next one is salary payable, another current assets. So in front of the bracket, we have to put minus since it's a liability, outflow, negative. Beginning balance salary payable minus the ending balance of the salary payable. So what we're going to have? Negative bracket 36,400 minus 25,200. Boom, close the bracket. So where we are here, negative 36,400 minus 25,200. One bracket here. I forgot the other bracket. I know it's not gonna give me this one. I forgot the bracket here. Boom, done. So our cash went down with $11,200. Let's see if this makes sense. So we paid the expenses for the salary, plus we clear some of the outstanding balance that we have in the salary expenses by using 11,200 cash. But once we're reducing the salary expense payable, that means we're using more cash. Makes sense? Everything is fine. Next one is the interest expense. Negative expense, since it's negative payable, sorry, not expense here, payable, interest payable. Since it's a liability, negative in front of the bracket. Beginning balance, interest payable, minus the ending balance of the interest payable. Negative 39,200 minus 47,600. Close the bracket. Let's see now what's happened here. Negative bracket 39,200 minus 47,600. So we have increase in our cash with $8,400. Let's see, do we have increase in accounts payable? Yes, we do. Do we building accounts payable? Yes, we do. What that means? That means we purchase we get what we get, but we didn't pay for it. We preserve the cash, 8,400. And that's all with the liabilities now. Let's mark those one with different color. Those are the assets, those are the liabilities. So let's see what's the net effect here. Net effect is $16,800 increase in our cash. So how much will be our cash from the operating activity? Since we're working now with this number, 3,800 plus 16,800, you have to make adjustment in your calculation as well for the formula. And that's how we're getting the net cash flow from operating activities. Let's go now. This company, again, this is baby question. Should be very straightforward, super easy for you. We have assets. Partial, this is partial balance sheet, complete income statement. We have assets, we have a current capital assets, accumulated depreciation, accounts payable, interest payable, sales, cost of goods sold, depreciation, loss, income. As you can see, nothing scary here, nothing super artificial. Let's go with the current assets. Inventory, we have our current assets. Accounts payable, that's a current liability. We have to take it into consideration. Interest payable, current liability as well. We have to take it into consideration. And we have all these items, sales, cost of goods sold, gross profit, that's a calculation. Depreciation expense, loss of sales. We have to prepare cash flow, operating activities only under the indirect method. Starting with the company name again, statement of cash flow for the period, and cash flow operating activities. Starting point is net income. And we have our net income, that's 49,000. Next thing that we have to do, we have to adjust for the non-cash items. Is there any non-cash items in our income statement which affects our net income? We're looking at the items, we have sales, cost of goods sold, then we have depreciation expense. Is this a cash item or non-cash item? What you say, cash or non-cash item?
Non-cash.
Non-cash item, yes, please. Speak up a little bit faster so we don't waste too much time. So what we have to do with this depreciation, we have to add it. Let's start adding. First, we're gonna add depreciation expense. How much we're gonna add? Exactly the same amount which depreciation expenses. Since depreciation expense reducing the income at 6,000, we're gonna add this 6,000 back to the income. Next thing, we have loss on sales of capital assets. Is that cash item or non-cash item? What you say? Cash, non-cash?
Non-cash.
Non-cash. Let's deduct it. Sorry, let's add it back. Let's eliminate it from here. by adding it back to our income. Since here reducing the income with 1,000, we're going to add it back 1,000. So if we add those $7,000, what's going to happen with our cash net income? Our cash net income will be $56,000. Boom, done. First part is done. Now we have to adjust this calculation. I'm going to delete it for now. Don't bother us. Next thing, what we have to do next thing? We have to do changes in working capital. What we have to do? Current assets and current liability. We already have it highlighted. Let's start with inventory. Inventory, beginning balance of the inventory minus the ending balance of the inventory. So what that means to us, I have to make some adjustments here. What's going to mean to us in the brackets, we're going to have 73,000 minus 70,000. Equal to 73 minus 70. We have increase in our cash with $3,000. Well, obviously, if the inventory goes down, that means we're selling that inventory, which brings $3,000 cash. Looks okay. Everything's fine. Let's go with the accounts payable. Accounts payable now is a liability. So for our formula here, we have to put minus in front of the bracket. And we're going to have beginning balance of accounts payable minus the ending balance of accounts payable. And let's go. Negative bracket 56,000 minus 55,100. As we can see in glass, balance going down. Let's see what's the decrease. Negative bracket 56. No, that's not going to give me 56,123 minus 55,100. Close the bracket. Boom. So I have reduction in my cash with $900. What that means? That means I pay for my expenses plus I paid $900 for my accounts payable from the previous period, which reducing my cash with 900 extra. Next thing, interest payable. Again, since it's payable, negative in front of the bracket, beginning balance of the interest payable minus the ending balance of the interest payable. Close the bracket. In the brackets, we're going to have negative in the bracket 2,000 minus 3,200, and that's going to give us negative bracket 2,000 minus the 3. Oops, not this one. Let's start again. Brackets 2,000 minus 3,200, and that's give us $1,200 increase in cash. Accounts payable goes up. That means we having the expense, but we're not paying for it. So we're saving the cash. 1,200 saves in the cash. We increase in cash to 3,000. Total increase from the changes in the working capital, we have 3,300, and that means our cash from the operating activity will be 56 plus 3,300, and that's going to give us 59,300 cash from operating activities. As I said, this was a baby question, nothing scary here. Okay. This question. This company, now we're going to go a little bit more complicated. Not only operating activity, we're going to start doing the other activities. which are investing and financing. So this company balance sheet is prepared. Was quick observation of the balance sheet. What we can see, we have cash, accounts receivable, inventory, equipment, depreciation, total. Payable, taxes payable, common shares, retained earnings. So they don't even have a long-term debt. They have current liabilities, equity. Current assets, long-term assets. That's all. Then we have sales, cost of goods sold, profit calculation, depreciation expense, other expenses, income from operation, income taxes. So as far as I see, there's only one non-cash item, depreciation. There's no gain, there's no losses, there's nothing like that. Right? So now let's see the additional information, what they say in the additional information. Sometimes the additional information is also important. Additional information, equipment is purchased for $16,800 cash. The 11,200 common shares were issued for $250 per share. They declare and pay cash dividend during the year. What we have to do, prepare the cash flow statement for the 2014 that reports the cash inflow and outflow from operating activities. Activity accounting to the indirect method. And we have to show our supporting calculations. So we have to use the indirect method automatically. That means our cash flow statement is going to start with the name of the company. Name of the report will be statement of cash flows. Cash flow is plural since we have four for the period ending December 31st, 2014. Cash flow from operating activities, that's the starting first one. And then our starting point is indirect method, net income. Do we have the net income? We're going and checking the income statement. We have it $93,800. Well, our starting point is here. Now, from the income statement, now we have to normalize this income into the cash income by removing or adding back the non-cash items. As we said before, the only non-cash item I'm seeing is the depreciation expense. I don't see any gain, any losses, anything like that. So depreciation expense, since it's an expense, we have to add it back. Let's add back depreciation expense. And we're going to add it back, and we're going to add exactly back $25,200. And that's all. That's all we're adding back. $25,200 going to our net income in order to be normalized. And now we have the cash net income. Next thing that we have to do, we have to check for the changes in the working capital. Cash, that's why we prepare a cash flow statement. Now we're going to see is this difference actually is going to be shown on the cash flow statement. Next thing is accounts receivables. Let's start with the accounts receivables item. Let's make some adjustment in those cells, by the way, just to make it more presentable. What we're going to do in alignment, we're going to increase this to 3, boom, done, depreciation expense. Actually, that's too much. Let's show it a little bit less because we want to save a little bit from the space. Let's go with 1. Yeah. Accounts receivables. What we have, bracket, beginning balance, accounts receivables, minus the ending balance of the accounts receivables. Close the bracket. And in this case, we have bracket 37,800 minus 43,400. So what we're going to have? We're going to have here 37,800 minus 43,400. That means our cash going down with $5,600. Why is that? Because we did the sales, we didn't collect the receivables. Our receivables goes up. Every time when the asset goes up, we're missing the cash. Next item, inventory. Bracket, beginning balance inventory minus the ending balance of the inventory. Or with the numbers, we have 249, 200 minus 284, 200. Now I have to make some alignment here so we can go this direction. So where we are here with 249, 200 minus 284, 200. So we have a reduction in our cash due to the inventory of $35,000. Does that make sense? Well, if the inventory goes up, that means we're using cash to pay for that inventory. So that's totally makes sense. The balance, the cash to reduce because we're increasing inventory. Current assets done. Let's go to the current liabilities. First one is accounts payable. For the accounts payable, since it's liability, negative in front of the brackets. Beginning balance accounts payable minus ending balance of accounts payable. So we're going to have negative bracket 44,800 minus 32,200. Once we go to the actual calculation, negative bracket 44,800 minus 32,200. And that's going to give us decrease in our cash with $12,600. What's happening here? Accounts payable is going down. So what that means, we're paying from the previous year balance accounts payable to reduce the accounts payable. Reduction in accounts payable equal to reduction in our cash. Next one, we have income tax payable. Liability minus in front of the bracket. Beginning balance, interest, income tax payable, minus the ending balance of the income tax payable. Close the bracket. In the brackets, let's go to the other actual bracket. That will be 11,200 minus 12,600, which transfer to brackets minus bracket 11,200 minus 12,600. Or increase in our cash, finally some increase in our cash with $1,400. Why? Because we incur the expenses, but we didn't pay for the income tax expenses, so we didn't pay. We pay less taxes with $1,400. That automatically brings the positive in our cash since we're not paying. Up to this point, from the depreciation expenses, adding back the depreciation expenses, we have increased with 25,200. And from the changes in the working capital, we have deduction of our cash was $51,800. So the net cash from operating activities in this case is equal to 67. Let's make it like this. $67,200. We have net cash flow from operating activities. Now let's do the next one, investing activity. We haven't done this before, but let's start doing it. Net cash flow from the investing activities. Investing activities, including the long-term assets, which is equipment and account accumulated depreciation. Now let's see what's happened here. We have account for equipment, and we have account for accumulated depreciation. What's interesting with those accounts, equipment is the asset account, so normal balance is debit. The accumulated depreciation is the contra account to the equipment, so the normal balance will be credit. So if you have to put here debits and credit, that will be my debit here, and that will be my credit here on the other side, obviously. And there we go. And I can easily flip those one to all the accounts that I'm using here. And I can easily flip this one to the older accounts that I'm using here. Equipment, beginning balance, we have 138,600. Ending balance ending balance is going to be equal, no, in this case, the ending balance is 155,400. Depreciation, starting balance is 47,600, ending balance is 72,800. Now, what we know about the depreciation expense? Depreciation, now accumulated depreciation is driven by the depreciation expense. So every time when we have depreciation expense, debit depreciation expense, credit's gonna go to accumulated depreciation. Now let's add this depreciation expense, 25,200, and let's see if we have this expense plus beginning balance. Does it give us the ending balance? Yes, it does. So this account is checked. Everything matching. We have no problem with this account. This whole account is checked. I'm gonna highlight it in green. Once it's checked, green. Why? Because the beginning balance plus the depreciation expense give me the ending balance depreciation. So what that means is there's no sale of assets. There's no credit needed on the no debit needed on the accumulated depreciation. Let's go with the equipment. I have beginning balance 138,600, ending balance 155,400. Let's check additional information. They're saying that the equipment was purchased for 16,800 cash. Let's put here 16,800 cash. And is that solve my problem? Well, the beginning balance plus the purchases, that will be the purchase. It's giving me the ending balance. That will be the depreciation expense. Solve my problem. Now we have a purchase new assets. Now the question is, how did they pay for it? Did they pay cash? Yes, we pay cash. So what that means, that's going to reduce our cash. Now we're going to have on the cash flow from the investing activities will be cash or purchase of equipment. And that will be negative $16,800. And since it's the only, let's see, now the equipment account is checked. Depreciation account is checked. So I know exactly what's happening in those two accounts. Here I have a purchase of 16,800, and that explains the difference in the beginning balance and ending balance. And I have depreciation expense 25,200, which explains the difference in accumulated increase in accumulated depreciation. So I know everything about those accounts. I know from where the cash is involved. There's no cash here. I'm done. So for my cash flow from the investing activities, I have only one item. So my net here, net cash for investing. Activities in this company is equal to negative. Let's click one more here, and let's erase one of this one, and that's going to be exactly this amount. I have reduction in my cash because of the purchase of the equipment with $16,800. Now the last thing that left is the two accounts, common shares and retained earnings. We have to see what's happening in those two accounts. First account, common shares. Normal balance great since it's the equity account. Beginning balance 336,123. Ending balance is 364,123. Let's see additional information. Is there anything related to the common shares? Yes, there is. They're saying that 11,200 common shares was sold or issued for 2.5 per share. Let's get here. Now that will be 11,200 times 2.5. So I have increase in the common shares with 28. If I add 28 to 336, is that solve my problem? I'm checking. Looks like I'm okay. So the beginning balance plus the issuing the shares give me the ending balance. So this account also checked. Issue common shares. Now, what I get for the common shares, once I issue the common shares, I get cash. So that means that's $28,000 I have increase in cash. Why? Because cash from issuing of common shares. And my increase here is equal to 28,000. Now the last thing that left is retaining earning. That's the last account that we haven't checked yet, and we don't know yet what's happening in. So let's start. First, retained earnings. We have beginning balance, 40,600. We have ending balance, 82,600. What we know about this account? We know about this account that net income from the year is going to increase the retained earnings. And if there's dividend, those going to decrease the account. Let's check what's our income. Do I know my income? Yes, I know. My income is 93,800. So 40,600 plus 93,800 is give me 134,400. But my balance is only 82,600. So I have too much here. Now let's check the additional information. Additional information says declare and pay cash dividend during the year. But they don't give me the amount. The question is, can I get the amount of my dividend? Well, beginning balance plus the credit in this case minus the debit is going to give me the ending balance. So the question is, if I have, and again, the formula is beginning balance minus, plus credit minus the debit, it's going to give me the ending balance. But guess what? I know the beginning balance. My beginning balance 40,600. Plus, I know my credit, 93,800. Minus, I don't know my debit, but I know how much will be my total. My total will be 82,600. So the question is, can I solve this equation for the debit? What do I have to do? I have to flip the debit on one side and flip the 82 on the other side. So what's going to happen? 40,600 plus 93,800 minus 82,100, 1,000 is going to give me the debit. So my debit here is going to be equal to this one plus 93 minus 82,600. I forgot here to put the 600. Sorry. 600 here. So if I have 50,000, 40,600, let's do the check. This one plus my income minus my dividend, it's going to give me 82,600. This account is checked, everything, calculation is correct, everything's fine. So what that means, during the year, this company pay cash dividend of $51,800. So let's go here. Cash for dividend, cash dividend. And we paid amount of negative 51,800, which is gonna reduce our cash. So on the net cash flow from that financing activity, let's highlight it here. That was for the investing activity. Let's highlight it. So from the financing activities, we have reduction in our cash with the 23,800. Why? Because we issue common shares for 28 and we paid cash dividend of 51,800. So my net outflow for the financing activity is 83,800 negative. So let's see what that gives me. That gives me in the very beginning, let's delete this thing. In the very beginning, I started with a 93,800. Then I added from the depreciation expense to normalize my net income to the cash income, 25,200. Then I deducted for the, actually, yes, I deducted from the changes in the working capital, 51,800. Then I deducted from the cash from the investing activity, 60,800. And then I deducted from the cash from the financing activity, 23,800. That's too much here. That doesn't make sense. So let's do it very simple. Let's go with this cash, 67,200 plus 16,800 and plus 23,800. It's going to give me net increase in cash of 26,600. So what I have to do? Now I have to see where my cash is. My cash in the January 1st was 54,600, as you can see here. At the end of the year, my cash is 81,200. So my cash increase change with 26,600 increase. Is that how much I'm getting from my cash flow statement? Yes. So if the owner of the company asks you, why I have increase in my cash, first, he's going to ask you, how much is my increase in my cash? Okay, I see increase. How much is it? And you're going to tell him, the increase in cash is 26,600. From where that came from? Then you're going to explain. From the company operating activities, we have increase in cash with 67,200. During the period, company invested in the equipment, and that reduced the cash with 16,800. For the same period, also the company issued common shares and paid the cash dividend, which also decreased the cash with 23,800. So the net increase in cash is 26,600 because of the increase in the operating activity, reduction in the investing, and outflow for the financing activities. And that's your cash flow statement with the all cash flows in one place. Means you have now operating activities, investing activities, financing activities. Again, that's how you're getting the missing information on the questions like this. The very simple thing is, again, if we delete all those this information, and if you delete everything, we're starting. What's the beginning balance? I have the beginning balance 525. My beginning balance is 525, 123. What's my ending balance? My ending balance is 1087, 123. Then what's happened? I have a new purchase, acquisition coming, 735, 123. If I plug that one, 525 plus 735, it's equal to 1,260,000. But my ending balance is 1,087,000. So I have $173,000 difference. Now, my amortization expense is 43,000. And since I'm working with the net, that amortization expense is going to affect this account directly, 43,123. So now my difference is only 130. What that means? That means that the asset that I sold or property, plant, and equipment that I sold, since I know that I have a gain on the sale of the property, something going out, the cost of that, the net cost of that is 130,000. If I have to prepare the journal entry, debit will be cash because I'm selling something, I'm getting cash. I have a gain of 19,000. I already know the net amount of my property, plant, and equipment. Net amount is 130,000. So the only option that I have for cash is 130 plus 19, or I get proceeds from this sale on $149,000. Now in the slides, this one is explained different way. If you look at the slides, let me find the slides. Where are the slides? Let me try again to share my screen here. In the slides, the whole thing is explained a little bit more. Again, start with the T account. For me, the best explanation is the T account, because on the T account, you can see everything. Beginning balance, ending balance, how much you purchase, what's on the other side, accumulated amortization, coming from the accumulated the amortization expense, and that's how you're getting the book value of the asset sold. So once you have the book value of the asset sold, and you know that you have a gain, 19,000, how much cash you get? 149,000. If there's a loss, then from 130, you have to deduct the loss to get the cash. But technically, what you're doing is dissection of the T account and find out what's happened in this T account and come up with the journal entry of the sale of the asset. That's why it's important. And it's, as you can see, the cash flow statement is given to you at the point when you already know all the journal entries for all the assets, current liability, long-term assets, long-term liability. So you can actually identify what's the cash portion, what's not cash portion, in order you to complete the cash flow statement.